Hello, good afternoon and welcome. And you've tuned into Mutual Fund Corner on CNBC TV 18. I'm Vinny Motiwala in the Mumbai studio. Now, during this year, 2025 beginning, we've spoken about what to expect from mutual funds in 2025, in sectoral mutual funds, individual ETF funds. What are we looking at? But we've not spoken about specifically commodity-based mutual funds, particularly gold and silver funds. They've delivered a stellar return of around up to 19% in 2024, which is showcasing their strength as a portfolio diversification tool. Now, as we step into 2025, the big question will be, will this trend continue, and should investors start exploring other commodity-based mutual funds beyond gold and silver? To shed light on these topics and pressing questions, we are joined by our experts for today. We have Mrin Agarwal, financial educator and director at FinSafe India, as well as Kirtan Shah, founder at Credence Wealth, joining in with us to help us understand the opportunities and the risk in the commodity-based mutual fund space and how we'll be navigating through this year. Welcome and thank you so much for joining with us, Mrin, as well as Kirtan. It's a pleasure having you both on the show. Let's just start by talking about the basic in terms of the outlook that is there for commodity-based mutual funds in 2025. What are the factors that we are watching out for right now in 2025 that could be influencing the return of these funds in this year? Mrin, good afternoon, and take it across to you first.
Thank you, Vinny, and a very happy new year. And it's great to be on the show today. So, I'll specifically talk about gold, of course, silver also, but because, that's where there's a lot of investor interest. And, given the returns that we've seen in the last 1 year, again, renewed interest from investors to further invest. So I think, some of the factors that can, of course, influence the returns on these precious metals would, of course, being geopolitical tensions. So as long as the geopolitical tensions continue to be there, gold is seen as a safe haven. Of course, central bank purchases, which are continuing, especially, China, India, a lot of other countries still continuing purchases as well. And also monetary policy easing that we are really seeing across the world. And not to mention that, the demand from individuals, certainly, I think from an India perspective, remains strong. So I think, on the positive side, these are the factors that are going to really influence the movement of the prices of precious metals.
Okay, surely those indicators coming in for precious metals. Kirtan, good afternoon and thank you so much for joining in with us. But while gold, a bit of a highlight on gold and silver coming in, do highlight for us in terms of other commodity-based mutual fund as well. What are we expecting here for both gold, silver, as well as the other commodities?
Winnie, thank you so much for having me on the show. I think I'll take it forward from where Bril actually left. While we talk about commodity mutual funds, we are typically talking about three categories: gold, silver, and there is another category called the multi-commodity fund. Now, on gold and silver, there are two things that we believe that investors should keep in mind. Gold prices are typically supported by interest rates falling. Gold is also currently supported by a large central bank buying, specifically China, and a strong dollar is also a very great support for dollar. We think all these three things will play out in 2025. While 24 has been good, 2025 can also be decent. May not be as good as 24, but 25 can be decent. On the other commodities, I think a lot of these commodities largely are dependent on what China typically ends up doing. So if the Chinese markets end up announcing a big stimulus, then probably it can play out well for the other commodities. But we've seen lately China work on stimulus twice, thrice, but that has really not impacted commodities that great deal, and hence we feel 2025 probably other commodities may not do well and the focus can largely be on gold and silver.
Okay, other commodities may not do well. Gold and silver will be the large focus area coming in, and obviously a lot of global factors, Mrin as well as Kirtan have highlighted, especially the China factor coming into play and the global situation in terms of the geopolitical developments that we've been seeing coming in. So maybe these two still could be performing better than other commodities is what we understand. But what percent of an investor's portfolio should ideally be allocated to a commodity-based mutual fund? And for a diversification purpose, how should it be working? Kirtan, let me go across to you first. If you could give us an understanding in terms of both gold, silver specifically, or should they even look at multi-commodity funds like you were mentioning? Though it may not perform that much, but is that something one could look at this time?
See, ideally, while we talk about mutual funds, the multi-commodity exposure is only through investments in equity stocks of company which directly, indirectly are commodity linked. And I think that will become a more thematic play, which a lot of investors will need to be very cautious of, not only when to enter, but also when to exit. Because if you're not able to do that, you will get into a wrong cycle, and that cyclicality might not work in your favor. So I am somebody who believes that if you really want to take diversification, and specifically on the commodity side, gold and silver should only be the commodity funds that you should ideally focus on. And in my opinion, 10% of your allocation can definitely go towards investing here, because this can also end up acting as a more tactical bet in the near term, because you will typically see when the risk assets don't do really well, I think the allocation moves towards gold, and that typically helps you balance your portfolio. So 10% of your allocation to gold and silver, and I'm not somebody who's very keen on taking multi-commodity exposure through mutual funds.
Okay, Marin, what's your view? You know, what would you advise an investor as well? 10%, does that seem fair enough, or a bit more is what we could expect, given that if gold is going to see a rise in terms of prices or the geopolitical tensions, would you allocate a bit more?
I would say 10 to 15%, not really more than that, because, you know, when you actually work out the returns, what you would actually see is that the upside by increasing the allocation to gold is not that much, honestly. So I think, you know, as Kirtan said, a 10 to 15% number is good enough. And again, my favorite would be gold. I would certainly not look at the multi-commodity funds, you know, because as Kirtan said, it is going to be a thematic play. And between gold and silver, my preference would still be on gold.
Gold and silver, that's the pick coming in, and gold obviously continues to shine. That's the word coming in from both our experts. So multi-commodity funds, maybe not that exciting, but gold and silver expected to continue to shine. You know, Kirtan, just a point, what is ideally the return that you see normally coming in from gold and silver, you know, mutual funds? While 2024 around was 19%, is that something that has historically also been a good return that one could see from these funds?
I think these funds are largely ranging anywhere in between 10 to 12% on a three to 5 year play. But I think what investors really have to understand is that while you invest in gold, gold is typically a tactical play, right? So you will see gold do very well for 2-3 years, and then there is a slack for another 2-3 years. So do not enter gold with an expectation that it will keep moving up every year. The average return expectation should not really exceed 10-12%, and in good years you may see what happened in 2024 may continue, but 10-12% is a good return expectation that you have. But largely when you invest in gold, I think the objective is not to be able to generate significantly higher returns than equity, but to bring that small balance to your portfolio, because when equity funds don't do very well, typically you will see a lot of push or allocation move towards gold in terms of balancing of the portfolio. So while you invest in gold and silver, you are looking at largely a more balanced approach to your portfolio with a 10-12% CAGR with a 3-5 year investment view.
And Kirtan, you know, if someone has to, you know, have to give a top 3 in terms of the performance wise, what you're expecting on how an investor should go in investing in 2025, gold funds, silver funds, and multi-commodity funds, if you could just line up top, the first one being the best and 3 being the best.
I think you've actually given the same numbering that I would have otherwise done. So it's gold, silver, and the multi-commodity. See, multi-commodity largely is extremely dependent on what China does, because a lot of demand is actually driven in these commodities by China. So if Chinese markets revive, these guys will end up doing well, which is not the base case. But we really feel that gold and silver should really top the charts versus the multi-commodities.
Okay, and Marin, I think you already mentioned, right? Gold, silver, and multi-commodity, just confirming.
Yes.
Okay, so that's how we are looking at in terms of commodities, gold, silver, and then comes the multi-commodity fund. But let's move on to the next question for now. And, you know, in terms of overall, when you're looking at it for the multi-commodity funds, or even in terms of what we should be looking at in terms of silver and gold, historically, these are the favorites, right? When you look at it in terms of investors, historically, they like gold and silver funds. So what are we watching out for in terms of broader basket, the risk and return that we're watching out for here in both these funds? Kirtan?
I think we need to start with today while we are talking about gold and silver. They have a lot of influence of what global geopolitical looks like, right? Like, say, for example, Trump is going to take charge soon, and there is an expectation that inflation might go up when Trump ends up taking charge at the helm of things, because there are two things specifically that Trump is expected to do. First is cut corporate taxes, which is also going to impact consumption, and also increase import duty or put tariffs, which is also going to increase landed cost of commodities or goods in the US. Now, both of these things are expected to increase inflation in US and inflationary situation in US. Now, because of which the rate cut, which was expected to happen in 2025, that expectation has gone down. But the positive side of Trump taking charge is we've seen in the last tenure that Trump was around that war and geopolitical developments are not going to be of very significant impact. Now, both of these things, like I said, and I have been saying since the start, maybe positive to a certain extent on gold and silver, may not be as good as it was in 2024, because in 2024 you saw the yields fall down significantly. You saw rate cuts from the central bank, and because of inflationary pressure in 25, you may not see significant yield falls or rate cuts, but it will still end up supporting gold and silver prices. But that may not be the case with the other commodities, because all the Trump policies and in general, China is not expected to do well.
Right. And Bryn, just a word in terms of risk reward. How does that shape up for gold and silver funds? What are we watching out for there? Is there any balance that one could be maintaining here?
So I think Kirtan did spell it out, but I just wanted to share some numbers, right? So again, I am actually very negative on silver, despite the fact that it's, of course, one of the best performing asset class this year. And of course, the fact that it's used for semiconductors, EVs, and all of this. But, when you actually just look at the returns, right, on silver versus gold, right? So there was this data that I saw in Value Research, which was that if you look at the last 5-year returns from 2019 to 2017, 2019 to 2024, you would actually see that the 5-year returns in silver range from -2% to 21%, right? Now, gold was more stable. The returns range from 7 to 19%, right? And Vinny, I have seen periods where 10-year returns on silver have been like 4%, right? So I am actually not very keen on suggesting silver. Also, if you look at the volatility that's there in silver, it's much, much higher than what is there in gold. So essentially, all that I'm trying to say is that gold is more stable, has lesser price volatility as well. And I think, from that perspective, investors really need to do their own research and not go by the fact that it's given 40% in the last 1 year, or, not just buy it because the returns are so high on silver, right? It has to be really based on the, really researching and studying all the factors put together.
Absolutely. Keep research, study all the factors. That's going to be key to watch out for as well while you're investing in these funds. But on that note, we're going to slip into a very short break. On the other side, we'll continue this discussion with Mrin Agarwal as well as Kirtan Shah, so don't go anywhere. Welcome back to Mutual Fund Corner on CNBC TV 18. Today we are discussing commodity-based mutual funds and how you should be looking at them. Now, while we've spoken about what impacts it and how you should be investing, what percent of your portfolio should be coming from this, let's move on and talk about how should it be treated. Short-term, long-term investors, who should be looking at it? And that's my next question, Bryn. Should commodity-based mutual funds be treated as a short-term tactical play or a long-term investment? How should one be looking at it?
Well, again, if you look at the long-term rolling returns on gold, for example, it's typically in a range of about 9 to 10%. But what one must remember is that there are periods where gold has also given a negative return, So, for example, I think 2012 to 2015. And the point also is that the during the year, so intra-year, gold also sees decline by 10 to 15%, right? So I would still say that it's better as more of a medium to long-term investment. So I would say, let's say 4 to 5 years and above would be a good holding period for gold.
Okay, 4 to 5 years would be a good holding period for gold. And Kirtan, do you also concur with that? Long-term investment, 4 to 5 years, is a better play coming in for these funds.
I think, Vinny, in my opinion, all of these three typical funds that we are talking about are all tactical in nature. Like the data shared by Mrin on gold, there is a similar data on probably silver and the multi-commodity funds. So I think there is no other way, depending on who you are as an investor. If you're a sophisticated investor, you will typically want to play this as a tactical bet in the near term, because these funds can end up giving extraordinary returns in the near term if you've got the entry and the exit of these funds correct. But if you are a retail investor who probably is using these funds from a diversification standpoint, from your overall asset allocation standpoint, then I would sincerely suggest that you stay invested in it for a long term, because in the short term, you will typically not be able to predict the cyclicality. And if you've invested in these funds for short term and you get caught on the wrong side of the cycle, you will see a 2-3 year of definite underperformance. So if you're a sophisticated investor, use this as a tactical bet. If you're a retail investor, this is definitely better for you from a long-term standpoint.
Okay, and Kirtan, anything if it's a first-time investor who's investing in these commodity-based mutual funds, what is it that you should actually check before you enter into these funds? What are important factors that we should keep an eye out on?
Again, like I said, I think in my opinion, if you're a first-time investor, you really have to understand that you don't want to do more than 10% of your portfolio largely here in these kind of funds, because these are cyclical, and only if you're a long-term investor, you should get into it. The objective largely here should be to bring a balance to your portfolio in terms of diversification. And you do not want to take tactical bets because the last year has gone well. Typically, you will see if the last 2-3 years have gone well, the coming 2-3 years will not be in favor, or not, the cycle will not be in favor. So don't look at the last 2-3 years of return before you end up investing in these funds, because you will typically get caught on the wrong side. So if I have to advise to a new investor, only look at investing in these funds 10% of your portfolio from a standpoint that you want to bring diversification, specifically including gold in your portfolio, and do not look at the last 2-3 years of return and get excited and invest, because you will typically catch the cycle on the wrong side, and you will have another 2-3 years of underperformance coming in.
Yeah, that would be a scary bet if that comes in right now, given that we've seen a good performance in the last year, at least in 2024, for gold and silver. But, how can retail investors start small with this category? How does that option work? What role does SIP actually play in investing in these commodity-based funds? How important is it?
So the minimum amount is really small, and you have the option, like if you don't have a demat account, for example, you can always buy the gold ETF FOF that where you transact through the fund house, and typically the minimum investment amount is only 500 rupees, and the SIP can also be done in the FOF as well. So just like any other equity fund, you could also look at increasing your allocation to gold using the gold FOF.
Okay. Kirtan, would you want to add anything to this as well, and advice to the viewers?
No, I think absolutely. I would sincerely suggest, because in my last answer also I said that these are technical plays. So the best way to approach investing in these can be a good SIP, is because as soon as you start doing an SIP, what you are typically doing is not investing a large sum at one point in time, because when you do that, you are ending up taking a tactical or a timing bet on the asset class, which is going to be very difficult in general as a retail investor. But when you do an SIP, what you're doing is you are averaging out your buying over a period of time and not trying to time the market. So definitely, in my opinion, also, ideally the best way as a retail investor you can approach this asset class is by investing using an SIP route and not trying to do lump sum. Unless the markets have significantly fallen and you probably think that, you're getting the asset class 20-30% lower than when you saw that. And if you have some lump sum money that you want to deploy, that's a very strategic bet. But in general, as a retail investor, SIP is the best way to invest, not just in this asset class that we are talking about, but in general as well.
True, SIP is the best way to go forward, not only in this, but other asset class also in mutual funds. Amrin, just a word, taxation, how does that work for these gold funds? Is there anything specific? Is there a different form of taxation that we see coming in here?
So in the last budget, the taxation on these funds has been changed. And so if you do a sale after April 1st, 2025, then the long-term capital gains on both the gold ETF and the FOF is going to be at 12.5%. There is a difference in the holding period, which is 12 months for ETF and 24 months for the for the mutual fund or for the FOF, basically. But yes, of course, the taxation is also now working in favor of these gold funds as well.
And obviously, while gold, obviously everyone does look at it in a physical form, apart from mutual funds also, anything else that, one should be looking at while looking at gold as a scheme?
I think you should really just stick to the gold ETF or the gold mutual fund, because as we know that physical form of gold is really expensive with all the overhead charges that are there. Now there are a lot of these jewelry schemes that are there, or the saving schemes that are there from the jewelers. I think today only there's a case that's been reported in a jeweler frauding the investors, right? So remember that most of the other schemes that are there, including like digital gold, and I have people asking me about gold leasing and all of these options, So the first and foremost thing that I would like to say is that whether it is the saving schemes from jewelers, or it is digital gold, or it is gold leasing, they're actually not regulated. So that's just reason enough to stay away from them, and go with a regulated product which is absolutely transparent and low cost as well, which is the gold ETF.
Absolutely. Stay with gold ETFs. That's a safer bet coming in instead of losing your money, which we've seen today trending across all these digital pages as well. So yes, be wary of that. Be wary of the risk that you're taking as well. But yes, that's the word coming in from Miran as well as Kirtan in terms of commodity-based mutual fund. 10% to 15% allocation is what we should be looking at for these gold and silver funds specifically. And both of them do like gold first, gold fund, silver fund, and then we go to the commodity-based fund. So thank you so much, Miran, as well as Kirtan, for joining with us on the show. It's a pleasure having you all on the show. And, it's been a great understanding commodity-based mutual funds as well and what we should be looking at. And viewers, thank you so much for tuning in to CNBC TV 18. And don't go anywhere. Closing bell is up next to take you through the last hour of trade.